This week on WealthTrack, how do you build financial security for a lifetime? That's the job of two chief investment strategists for two top-rated insurance companies. New York Life's John Kim and Western and Southern Sport Washington investment advisors Nick Sargen show us the building blocks for their portfolios. Next on Consuelo Mack, WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. In the news business, what makes it into the headlines is generally bad news, not good. Well, this week on WealthTrack, we are focusing on some of the positives we and our guests see developing, starting with our homes. The housing market is unmistakably on the rebound. After crashing leading into and during the financial crisis, home prices are now recovering and are expected to continue to do so. A major driver behind the housing recovery is affordability. It is the best on record thanks to a combination of the dramatic multi-year drop in home prices and record low mortgage rates. As a matter of fact, consumer net worth is on track to make a new high thanks to increases of the prices of houses, stocks, and bonds, as well as declines in mortgage debt. And speaking of stock prices, the gains are a global phenomenon. The MSCI All-World Index has broken out to the upside, and we know how well the U.S. markets are doing. Several indices have hit record territory. And finally, the most powerful trend of all is the widespread central bank easing that has taken place across the globe. The Bank of Japan is the last major financial player to fall in line. Lower global interest rates have made it cheaper to borrow, more difficult to save, and have pressured investors to move funds into riskier assets such as stocks and lower-grade bonds, to get decent investment returns. And finding decent returns that will last a lifetime is the job of this week's financial thought leader guests. Each is the chief investment officer of one of the oldest and highest-rated insurance companies in the country. John Kim is chief investment officer at 167-year-old New York Life and president of the New York Life Investments Group. In total, he oversees $360 billion in investment assets. New York Life is a sponsor of WealthTrack, but John is here on his own merits. He has a 26-year track record of running investment management and retirement businesses at other major insurance firms. Nick Sargen, a WealthTrack regular since the beginning, is chief investment officer of the Western and Southern Financial Group and Fort Washington Investment Advisors, the investment arm of the 125-year-old insurance company, where he oversees about $45 billion in assets. I began the interview by asking them how much the world has changed since I last sat down with the two of them in July of 2011.
The world has changed indeed a great deal. You have to start with the Eurozone Crisis, and back a year and a half ago, we were concerned, as most investment professionals, that the Eurozone was going to break apart. There was a liquidity crisis, there was a capital crisis, there was a growth crisis. Today, I don't believe liquidity is an issue. I think capital has become much more available, especially for the European financial institutions. So the issue in Europe today versus a year and a half ago is one of growth and politics, because we've got some important elections coming on in the latter part of this year. The second is that we're concerned about a slowdown in China, and indeed China did slow down, but many people were concerned coming into 2012 that it was going to experience a hard landing. It appears that it will likely orchestrate a soft landing and perhaps grow in the coming year. And then last but not least, the monetary policy around the world, starting with the U.S., has really gone from one of very easy monetary policy to all chips in. So whether it's Europe, the United States, and now most recently the Bank of Japan, those three regions comprise over half of the economy in the world. The central banks have basically said, we're going to provide as much liquidity as necessary to generate growth. And as a result, it's actually forced investors to go out on the curve, whether it's the yield curve for bonds, the spread curve, or certainly the risk curve here as related to equities. And that's why the marketplace has responded so favorably.
So, Nick, I saw you nodding in agreement.
Absolutely.
So anything to add to the big changes that John just elucidated?
I think he highlighted the big ones. The way I think about it, Consuelo, in the case of Europe, is we were asking for the first time the existential question, could the Eurozone make it? And the reason was we went from worrying about small countries, Greece, Portugal, Ireland, to the bigger countries, Italy and Spain. And I would say today we're still worrying about the economies. They're in recession, but tail risk, what does that mean? The risk that the financial system could collapse, that risk has dissipated. And it's amazing. Why? Because one man, the European head of the European Central Bank, Mario Draghi, said, we're not going to let the Eurozone fail, and I need the authority to go out and buy their bonds. He hasn't even had to buy a bond, and yet you've had the rally that John talked about. China, as he indicated, the fear was, again, property bubble and the like, and I would completely agree with him that the Chinese story and the Asian story in general is improving. Just lastly, though, I think on the U.S. side, what were we worrying about? The debt ceiling debate. In all the years I had followed the markets, I never even thought of that. And yet, here we have this issue that caused the rating S&P to downgrade U.S. Treasuries, to lose the AAA status. And we went into the first real downturn in the equity markets since the rally.
Right.
We lost
in August of 2011.
That's right. And so now, you look at it, and we went over the fiscal cliff. And investors kind of yawned. And they said, we've seen this act before, and we just don't take it seriously. We don't believe the two sides are going to allow that to happen. So that risk of policymakers making a terrible mistake, I think that's diminished.
So what's wrong with this in this picture? Not with this picture. This picture is a good picture. But what are you worried about, John?
I'm worried about the general level of complacency in the marketplace. So not summer of 11, Consuelo, but coming into 2012, there was a fair bit of pessimism in the marketplace. 70% of investors thought that the Eurozone might break apart. We were very concerned about the continuation of the QE programs and the like. And as a result, I believe the markets, corporate earnings, multiple expansion, all sort of surprised us on the positive here. There's a remarkable calm in the marketplace today. Many of our cohorts seem to be more optimistic than not, and perhaps it's the contrarian in me suggests that I'm just concerned that we're all too optimistic and we're too complacent about the year ahead.
So is there anything that you are doing as far as your investment strategy as a result of that?
Yes, we are.
What?
We still like risk assets, like equities and high yield bonds and even high grade bonds that are more on the speculative side here. But we're just increasing the credit quality of all our risk assets a notch here. So whether it's equities, we want to go into higher quality equities. On the fixed income side, again, while we still like high yield bonds, we might want to move a little bit on the higher end of the high yield sector.
Which is exactly the opposite of what other professional investors who are complacent and are optimistic
Indeed.
would be doing at this point.
That's right. They still have the risk trade on fully as we see it.
So, Nick, what are you worried about?
It's interesting. As I was listening to John, I can see where he's coming from, and yet I have a slightly different take. For example, I certainly agree that in some of the risk assets in the bond market, where we ask ourselves today, even investment-grade credits, are we being paid for the credit risk we're taking with the spread so narrow, the yield spread so narrow?
Right, and again, yield spread's the difference between the short term and the long term.
Exactly. But here's the difference so I think the complacency is on the bond side. Mm-hmm. The stock market has had a phenomenal run, but I think, quite frankly, many people missed it. And why do I say that? Consuelo, I looked at mutual fund flows. Up until the beginning of this year, a steady pattern of outflows from equity mutual funds and ETFs into bond funds.
Oh, absolutely.
Then you could say, well, what about maybe not so much the institutional investors, but even there, I saw something that was really surprising to me recently is on pension funds. Their allocations to equities after the financial crisis came down, I think it used to be 55% to 39%. Their allocations to bonds went up from 22% to the mid-30s. And so what I'm saying, the difference is, I agree with John on the bond side. I still think that there is more legs to the stock rally, even though we may have a pullback. But I don't worry that investors are overly positive on the stock market.
On the equity side, the only concern I have about the equity side is that last year's 16% performance of the S&P 500 was really generated by a pretty material multiple expansion. Now, it was off of a fairly low PE multiple, so I calibrate something called the trend PE ratio, and that ended the year at 17 times earnings multiple. That's a historic average, so the equity market is only cheap vis-a-vis the bond market. Versus historical averages, it's about fairly valued. So I am a little bit more cautious than Nick is that the equity market, while it might have some more room to improve, that there might be limitations to that. That's why I don't think it's going to realize the total return growth that we experienced in 2012.
So what do you think is going to drive stock prices higher, Nick? And do you think they're going to go substantially higher, or?
The answer is...
And I don't know what substantially means.
Well, that's
right.
You tell me. Can we test the all-time high for the S&P, say 1570, 1575? I think it's possible.
Sure.
Yeah,
right.
We're not that far away.
No, we're not far away at all.
And so I think that the basic story that I feel, Consuelo, is the key question I ask myself is the U.S. economy gaining traction in the private sector? In other words, if you looked at the headline number for the economy, it doesn't look all that exciting, 2% growth. If you say, what are people forecasting? 2% growth. But what makes me more optimistic is that I break out of that the private sector component, the consumer spending, the business investment, the housing sector, which I think is really coming back, as well as the export sector. And I take out the government sector. So the basic story is when the economy was beginning recovery, you needed that government sector to give the economy the boost. Now we've gone from stimulus or push to a drag, and the private sector is still expanding at a healthy clip. So my call would be that we're going to accumulate getting stronger growth, better jobs growth, and then that's going to help buoy confidence. So what I think will happen then is all these flows into the bond funds start to migrate back into stock funds. That would be the basis for it. But I agree with John. It was a great run last year. I'm not promising, we can't promise, but do you get 16% return? No, I don't think you're.
Is the bond market in a bubble now, John, number one? And number two is, when are interest rates going to go up, and what should investors do to plan for that?
A bubble implies that it's going to burst soon. And by that definition, Consuelo, I would say that we're not in a bubble. I actually believe that there is a reasonable chance that interest rates could stay low for a longer period of time. But I believe it's not when, it's the issue is when, but not if here. So when you have a 1.8%, sub 2% 10-year Treasury rate, I just don't see over a 10-year horizon how that could be an attractive investment. So while I might not call it a bubble, this is really not a time for active investors over the long term to be investing in the long end of the bond market as their core investment vehicle.
So do you think that there's going to be a change in the bond market, and if so, when, where rates start going higher, and therefore your underlying principal is going to decline in value?
Yes, I think there's a decent chance that there could be a rise in interest rates here this year, especially if you adhere to Nick's sort of economic forecast, which I think is reasonably accurate.
So a little bit more growth than consensus.
And again, to underscore the point made earlier, If you look at the mutual fund flow data, it's really been $1 trillion over the last 4 years that have moved out of the equity market into the fixed income market. And so the big question is what's going to begin the shift back to equities? Will it be a 50 basis point rise or a 100 basis point rise? Somewhere in that range, there's going to be a shift, and I would agree that when that shift occurs, it's going to occur fairly quickly.
And are you talking about a rise in the 10-year note?
I am,
All
exactly. Right. So which is, again, slightly below 2% today.
Right. And Nick, you told me earlier that you're actually strategizing it for Washington Investment Advisors, and you might be too at New York Life, as to kind of when. I mean, not when and not if interest rates start to rise. What do we do? What do you do? Well, and when do we do it?
Yeah. Well, let's do the when first. What should you focus on? It's pretty simple, I think. The Fed has said what they're focusing on is the decline in the unemployment rate to 6.5%.
Right, that's what they've said is their target.
7.8. So we're a long way from that. So the Fed, it's not that the Fed will begin raising interest rates, but the market says, I'm going to watch what the Fed's watching. So again, my story would be, Consuelo, of late, job growth on a monthly basis has been about 150,000 new jobs a month. That's not going to move the needle. That's priced in. But if we start printing 225,000 jobs, I think the bond yields that John's talking about, they're going to rise ahead of that. So that's our cue. So now, what do you do in the meantime? We're developing contingency plans because, like John and I'm sure, if we compared notes, let's say we're invested in corporate bonds. Guess what? The average value of our bond portfolio, and I'm sure it's for John's, is probably $115 for a par value of 100. So if you did nothing, or that would go back to 100. Mm-hmm. So
that's a big loss.
That's right.
Right.
So what we're saying is that,
from where you were today.
But you have to back your products, so you keep those bonds. But do you do certain types of hedging strategies to protect yourself in the event that you think there could be a rise in bond yields? So you can do that. The other thing I think, and it's too early to do this just yet, but if you said to me, how will things change? Floating rate notes will become a lot more popular when we do get to a rising rate environment, because they're not going to be subject to capital losses that fixed rate instruments are. And I think it's very interesting here. The Treasury is doing two things. It wants to extend its maturities. Why not? Lock in very low interest rates.
Sure. Right.
But they are developing a program, I believe, of also eventually issuing floating rate notes for those investors worried about rising rates.
Do you also have a contingency plan, or that, right. And again, that we could apply to individual investors as well?
Absolutely, Consuelo. So in addition to what Nick said about floating rate instruments that by definition have low or no duration here, the sector that we actually do like would be equity real estate, because they offer current income but also inflation protection, which is sort of the embedded in higher interest rates. There should be some higher inflation. So, and for institutional investors, you could basically invest in commercial real estate properties, and that's a very attractive category that we have been investing in. But for individuals, REIT stocks or REIT funds, exactly, are good places to generate some current income, but also provide you with some upside protection here if rates do rise.
The last time that you were on, we were talking about that you at New York Life, plan for these contingencies. And I remember one of the things that we were watching very closely were the Spanish 10-year note was trading, and and what the interest, and that was, it turned out to be a perfect barometer to figure out whether the markets were going to go up or down. So is there another similar thing that you're looking at now, or
there is. Inflation at some point is going to be problematic here, and again, this is yet another example of when, not if. And within the broad inflation statistics, we would look at payroll inflation at the core. So
wages?
Yes, wage inflation. So if Nick is right that employment growth is going to be more robust this year and beyond, that should translate into some wage inflation. And if you see that, that's a more permanent form of inflation, and we would be concerned that that might create a catalyst for larger inflation going forward, which would obviously increase interest rates, and you would have a lot of mark-to-market loss in fixed income securities.
Right. So where do you go for income? Which I know that you two are searching the world for income because of the obligations you have to meet as insurance companies.
Absolutely. Well, you know, it's interesting when John talked about the real estate investment trusts, our favorite play has been dividend-paying stocks, high dividend-paying stocks, for the reason, as I said, we look today and we go, if we had to buy a high-quality corporate bond, we can't put it on our books for 4% yield. Yet we are able to find in the stock market same companies maybe issuing stocks that have dividend yields above 4%. Mm-hmm. So for us, it's a no-brainer in two respects that we're getting comparable yield. But at the same time, we do believe over the long run, the stock market will outperform the bond market. So I'd rather hitch my horse to a market that can go up in value rather than hitch my horse to an asset that I think will decline in value. You know, there have been we have a whole range of initiatives. Some are master limited partnerships that we've looked into. We've looked into alternative investment vehicles that pay higher yields mm-hmm. than what a conventional bond would be. So I would say that in the last couple of years, I could easily tick off maybe 8 new initiatives we have to offset this very low interest rate environment.
And where are you looking for income?
So equity real estate, mm-hmm. The higher quality end of the high yield segment, recognizing that spreads for the high yield sector have really come in significantly. One of the reasons why it was one of the best performing sectors last year. I think the international arena still offers value, especially if you have a diversified strategy of both equities and fixed income, developed and developing. You can generate some yields that are quite attractive.
And as a matter of fact, that was the one investment recommendation that it was international stocks.
That's right.
When you were here a year and a half ago, which has actually worked out quite well. Exactly. And the one investment. So we are at the one investment for a long-term diversified portfolio. And last year, Nick with you, or in 2011, it was to buy a home when you were in the midst of building a home and it's finished. So what's your one investment now, Nick Sargen?
You know, it was interesting. I said, now this is personal. So this is, but I asked myself when we realized marginal tax rates were going up, capital gains tax rates, and I'm sitting on my own personal bond portfolio, that I said, wow, I have huge capital gains. If I sell it, I'm going to pay Uncle Sam. So I decided, what's better than doing that? Why not go get one of these advisory funds where you can make charitable donations.
So these are the
donor advised funds. Where you make a charitable, you put the proceeds of that bond into that. So I'm not paying Uncle Sam. I'm giving it to charity, and guess what? I get to have a tax deduction at the same time.
All right, good place to put some bond profits.
Yes.
John Kim, what would your one investment be?
High quality, high yield bonds.
High quality, high yield bonds, and they're not mutually exclusive?
Indeed, they're not. So the highest quality, high yield, by definition, is a BB rated. I would stay in that category. That means that you're not in the most speculative, but you're still enjoying a comfortable yield over treasuries.
All right, very important distinctions to make. So I look forward to doing this again in another year, and hopefully the good news will continue, but it's so great to have you both here. So John Kim, CIO of New York Life, and Nick Sargen, CIO of Fort Washington Investment Advisors. Thanks so much for joining us on WealthTrack.
Thank you, Consuelo.
Thank you.
At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider buying a home sooner rather than later if you are planning to be in the market for one. Now, up until recently, if you waited to buy a home, you could be almost assured that the asking price would go down and the mortgage rate you had to pay would decline. The exact opposite is happening now. Home prices are going up, and so are mortgage rates. Barring another financial crisis, it looks like it is becoming a trend. So waiting to buy a home no longer pays, and acting sooner rather than later might. Now, these are also the sentiments of next week's guest who invested early in home building stocks, which paid off big time last year. We will have an exclusive interview with legendary value investor Bill Miller, whose Legg Mason Capital Management Opportunity Trust Fund was the #1 mutual fund last year, up a rousing 41%. We'll find out why Bill is back and what strategy he is following now. If you have missed any of our past great investor or financial thought leader guests, you can find them on our website, WealthTrack.com. You can also see our new programs 48 hours in advance as a premium subscriber and see additional and extended interviews in our WealthTrack Extra feature. And that concludes this edition of WealthTrack. Thank you for watching. Have a great Super Bowl weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.